The world's most powerful economy was supposed to be untouchable, a fortress of endless credit. But what do you call it when that fortress begins bleeding $4 million in debt every single minute, and the very country that kept it propped up decides it's done playing the game? The United States entered the second quarter of 2025 bracing for strength, expecting to open its books and find $850 billion in cash reserves. But when the numbers were laid bare, barely half remained. And at that exact moment, like a hammer striking glass, China torched the dollar, unloading a colossal $1.7 trillion in U.S. treasuries. The ripple was instant and violent, sending shockwaves through the global financial system, rattling markets from Frankfurt to Tokyo. With its fiscal cushion shredded, Washington had no choice but to scramble, forced into emergency borrowing of $514 billion just to keep the lights on, a 300% spike above projections. Interest rates spiked, inflation ignited, nervous allies yanked their capital, and suddenly the most trusted debt in the world began to look toxic, radioactive. This wasn't noise. It was a signal. The old order, the one Washington had built and the world had obeyed for decades, was beginning to crack under its own weight. America was already staggering beneath a deficit ballooning by more than $4 million every 60 seconds. But now that weight doubled as Beijing pulled the eject handle. And this was no random sell-off. This was a deliberate strike, economic warfare disguised as a portfolio adjustment. The spark? Washington's decision to kneecap China's flagship EV battery giant CL, blocking U.S. banks from underwriting its $5.3 billion IPO. The Pentagon branded it part of Beijing's military-industrial web. Under pressure, J.P. Morgan and Bank of America walked away. What they lost wasn't just underwriting fees. It was future access to the Chinese financial ecosystem, losses that Reuters reported could stretch into the billions. Beijing's answer was ruthless. Treasury holdings were slashed to just $759 billion, the lowest in nearly a decade, while gold reserves surged for a fifth straight month, rising to 2,092 tons. This wasn't knee-jerk defiance. It was a methodical pivot, a carefully engineered retreat from dollar dependence, a calculated fortification of China's fiscal sovereignty. The message was written in numbers. IMF data revealed the dollar's share of global reserves shrinking from 64.7% in 2016 to 57.4% by late 2024. The slide was steady, relentless. This wasn't a tremor, it was a tectonic shift. The world's second-largest economy had delivered its verdict. U.S. treasuries were no longer safe havens. They were liabilities. And as Beijing stepped back, America stumbled into its own trap. Treasury officials had gone into the quarter assuming close to $1 trillion in reserves, but the books showed just $46 billion. The debt ceiling reinstated in January tightened the rope around Washington's neck, forcing emergency borrowing to dodge outright default. Treasury itself admitted that if reserves hadn't evaporated, borrowing would have been $53 billion less. Wall Street braced for $255 billion in new debt issuance. Instead, the number doubled. Confidence shattered. If Treasury missed this badly, what else had they failed to see? Optimists clung to the notion that Trump-era tariffs could plug the hole, filling government coffers with customs revenue. But that hope crumbled quickly. Apple alone reported a $900 million tariff hit in Q2 2025, with executives debating whether to raise iPhone prices to survive. Import costs surged, consumer inflation spiked from 2.2% to 3.4%, and the pain spread. This wasn't a temporary flare-up, it was structural damage. Imports were collapsing, corporate margins were compressing, tax receipts lagged, while interest payments on the runaway debt devoured more of the budget each month. For decades, U.S. treasuries were the bedrock of the global financial order, the asset every nation trusted. But in this new reality, with China, the single biggest buyer, walking away and reserves evaporating, that bedrock was beginning to crumble. The question was no longer if the system had changed. It was how long before it collapsed. Tariffs were sold as salvation, as a way to rebuild America's financial foundation, but the reality was starkly different. Each policy misstep, each botched forecast, each bond auction only tightened the fiscal noose. And behind every auction weren't just faceless institutions. It was families, households, ordinary people now paying more and getting less. By May 2025, the impact was brutal. 10-year Treasury yields broke past 6%. Mortgage rates surged to 7.8%, even 8%, the highest in 15 years. Those numbers weren't abstractions. They were fewer homes bought, fewer keys exchanged, fewer dreams realized. Freddie Mac reported auto loans piercing 9.1%. Student loans averaged 6.6%. The American dream was being repriced in real time, slipping further out of reach with every tick upward in interest rates. And what that meant was painfully simple. America wasn't just borrowing money. It was borrowing time. Credit is no longer a bridge to tomorrow. It has hardened into a barricade standing in front of millions. Affordability is evaporating not in pockets, but everywhere, all at once. The Consumer Price Index jumped 3.4% in Q1, accelerating from 2.2% the quarter before, driven by relentless food and energy surges. That's not ordinary inflation. It's compression, the kind that crushes a household's ability to breathe, to save, to dream. Bloomberg confirms that household purchasing power collapsed by 5.1% year over year, a decline that doesn't spread evenly across society. It lands with surgical precision on the middle class. Essentials once affordable are now luxuries, inflated by a dollar weakened 9% since Beijing began its quiet retreat. Costs are not just rising, they're compounding, feeding on themselves. And yet, even this is only the surface. Underneath lies a deeper fracture, geopolitical confidence breaking apart. In just the first quarter of 2025, foreign investors yanked $317 billion from U.S. assets, the sharpest capital flight since 2016. Treasury figures reveal Saudi Arabia, once among the top 10 holders of U.S. debt, slashed its holdings to $126.4 billion, a stunning 22% drop in under a year. At the same time, Congress injected politics directly into global capital markets, forcing BlackRock and Vanguard to divest $812 billion from 220 Chinese firms. The fallout was swift. Asian IPOs in New York collapsed. Where 3/4 of Asia's firms once flocked to Wall Street, only 28% did in 2025. Instead, Tokyo and Frankfurt are basking in a golden era of listings and liquidity. America isn't just losing money, it's losing its place. What's dissolving is not simply investor appetite, it's trust itself. Meanwhile, Beijing is not improvising, it is engineering. Washington spends to patch holes, but China is building a parallel system, systemic, structural, and permanent. In 2026, it will unveil its own national credit rating agency, cutting out Moody's, S&P, and Fitch. The China Institute of Finance and Industry estimates those agencies cost Chinese state firms up to 120 basis points in extra interest, despite solid balance sheets. For Beijing, this isn't just strategy, it's sovereignty expressed through finance. But the ambition goes further. A domestic cross-border payment system is being rolled out to bypass SWIFT, removing America's leverage in sanctions or financial conflict. Alongside, BRICS Pay processed $56.4 billion in Q1 of 2025 alone, nearly half of it outside the dollar. Bloomberg confirms, this isn't rehearsal, it's the new plumbing of global finance. These aren't tweaks at the edges. They are rewrites of the entire operating system of money, credit, and power. As this architecture expands, the question that once seemed unthinkable is now unavoidable. Does the US dollar remain the world's reserve currency, or is it already sliding into a regional role, held up less by necessity and more by nostalgia? Washington's answer has been to borrow bigger, faster. The Treasury's revised plan projected $514 billion in Q2, $554 billion in Q3, aiming to rebuild a federal cash balance of $850 billion. But reality is trailing far behind. By mid-May, only $563 billion was on hand, up from $46 billion in March, yes, but still 33% short of target. JP Morgan warns that betting on a smooth debt ceiling resolution is a fantasy on borrowed time. The market may not wait much longer as Washington's ambition and liquidity drift further apart. Rating agencies are circling. Lewin-Apps has already flagged Treasury's cash management as unsustainable without urgent congressional action. And while Washington debates, the world hedges. BRICS accelerates its financial independence. China unwinds dollar exposure. Even America's allies are quietly building lifeboats. The post-war financial order, the architecture that made the dollar king, is no longer untouchable. It is under review, under pressure, under active replacement. America now faces a binary choice: reform radically or drift into decline, hoping the legacy of its past will somehow substitute for the trust of the present. But the world isn't waiting. Mortgages climb. Capital flees. Allies reposition. The center of finance tilts eastward, not by chance, not by accident, but by deliberate design. And that brings the hardest questions forward, the ones no one in Washington dares to voice. What happens if the next Treasury auction underperforms? What if safe haven flips into systemic risk? What if the very tools of American power, Its bonds, its currency, its credibility begin to lose their aura. These aren't distant hypotheticals. They are